Good morning, everyone. Thanks for joining us today. Welcome to the Hancock & Gore High Conviction Half-Year Results Investor Call. We've got all attendees now in listen-only mode. On the call today, we've got Joseph Constable. So Joseph is an Executive Director of Hancock & Gore Limited, and he's the Portfolio Manager and Director of the H&G High Conviction Fund. I'll pass you across in a moment to Joseph to kick off our discussion of the company's half-year results. We'll have a presentation today, followed by an opportunity for Q&A. If you would like to ask a question during the call, please type it into the Q&A panel, which is in your Zoom app. So to kick things off, I'll hand over now to H&G High Conviction Portfolio Manager, Joseph Constable. Go ahead, Joseph.
Thank you very much, Tim. Appreciate you hosting this, and thanks everyone for being here today. Appreciate your support. So I'm going to be presenting, now that we've released our first set of accounts to the ASX, will be a good opportunity to update the market with our strategy and how we're tracking. So this is the important information, and this slide is on the ASX, so you can refer to it anytime. So for those who don't know much about H&G High Conviction, HCF, we invest in a concentrated portfolio of microcap companies that we believe are undervalued and overlooked. And the reason why we do this is because we believe this part of the market offers the most potential for long-term return. And as you can see by our relative performance, we are not too exposed to the vagaries of the general market, and we can perform in all sorts of markets. And that's really because we are focusing on this concentrated portfolio, select businesses, as opposed to the market at large. And also, as you can see, we have a track record. We've been going as the original fund, a unit trust, before we listed last year. We've been going since 2007, so we have an almost 16-year track record, and that's of superior returns. So we see ourselves as a unique offering in the listed investment company and general fund landscape, and that's really why we brought this product to market last year. So we are one of very few truly concentrated funds, and we target something like 10 to 20 companies in our portfolio at any time. And we're really the only microcap specialist, where our companies at the point of entry, when we first invest, are generally below $300 million in market capitalization, and mostly below 100 million, and often around the 50 million mark would be our sweet spot. So this is a very specialized part of the market. And to reiterate, we choose to focus on this area because we believe that we can get the best informational edge there. And we really only want to invest in companies where we believe there's deep value, and that's due to mispricing. And generally, this means that institutions aren't there looking at them. There's no real price discovery there. And the importance of being concentrated for us is that, well, we can have that informational edge, and it's difficult to have that once you get over the 15 to 20 holding mark. You have so many companies you have to be experts in. And also, we really like to strongly engage with the board and management of our companies. And again, that's very hard to do with more than 20 holdings. So this general strategy, we believe, has helped us materially outperform over a difficult last 12 months. But it's also important to mention that we did have a strong year, and we had some long-term holdings that came to fruition and success, and some shorter ones as well. And it's not indicative of how we're going to go every year. So investing in microcaps and in this part of the market that we focus on requires a significant amount of time and expertise. And the microcap sector is interesting because it's susceptible at times to sort of casino-esque hunting, where people invest without knowing too much about a certain company, because it could have an enormous payoff. And we've seen that behavior a lot over the last couple of years, at least up to late 2021. But we like to think that our approach in this space is actually the inverse, where we treat our portfolio as a collection of businesses in which we own slices and we engage very closely. So we're not simply putting together share certificates in our drawers and hoping that share prices rise over time. And it really means that we're happy to hold for the long term, sometimes 10 years or more. And most importantly, we can double down if share price is half, because we know so much about these companies. And a key point that differentiates us is that we're HCF is part of a wider investment group that, I should say it's managed by a wider investment group called Hancock & Gore. That's a public company, ticker H&G. And Hancock & Gore invests in a range of asset classes and has very deep networks and really knows how to add value to businesses. So we're not a silo, we're actually part of something greater, and that produces some fantastic cross-pollination and allows us to have a very wider focus as opposed to being too narrow in the way we think. And there's also very strong alignment, and that's my family owns 26% of HCF, and H&G, the manager, owns 7%. So we're very focused on shareholder returns and protecting capital. We're not looking to make a series of aggressive bets on other people's money in the hope that we can hit the jackpot and retire early. It's very much focused investing, and we believe our costs are modest, and all of our returns that we state are always net of the fees. So this slide gives a bit more color on our approach to investing. So what are we looking for? The first thing I'd like to discuss is mispricing. I mentioned this before. Interestingly, what we're doing is actually not that dissimilar to private equity, let's say, and especially because we are in the smaller end and less liquid part of the market. But the real beauty of the stock market, unlike private equity, is that, especially in this micro cap end, shareholders just sometimes give up. And what that means is they want to sell, they don't necessarily do the work, they might have inherited the shares, and it drives the share price down to an irrationally low level. And suddenly that's the market, and people believe that that company is worth that much, and it might have been like that for many years. And so you can't really escape that. So when we, as a potential buyer, come in, we're in a pretty strong position because the market has already said the company is worth that much. And if we believe it's very low, well, that's great. So in the private equity land, though, when there is no obvious market, the seller often has the path because there is no daily voting machine on the value of their business. So that's why we really like being in this listed space. And despite that difference, most companies that have made it to the ASX, and most of the ones we invest in have actually been on the ASX for many years, obviously have some legs because they've managed to get through lots of hurdles, lots of regulatory obstacles, and they do have potential, these businesses, but they often have had maybe some things go wrong, or shareholders wanting to exit, and that's what's driven the price down. So obviously to get to that position where we think that a company is mispriced, we have to have done an incredible amount of work, intensive due diligence. We have to be very selective, as of course, as in any industry, there are many charlatans, and it's always about the people. And we look at hundreds of opportunities each year, because there are about 1,500 microcaps, sub $300 million on the ASX. So there's a big universe to keep looking through, but we only invest in a handful each year, and at most 15 to 20 at a time. So in terms of discount to inherent value, once we establish that there is a significant mispricing action, we really have to become an expert in a company. And we have to get to the position that we believe that we can buy it at a big enough discount that we have a margin of safety, that if things don't go well, there's still significant amount of assets or businesses that can be sold. So we really just look to invest in real businesses where we have a strong sense of where value can be created for shareholders. So in terms of the next 2 points, lack of scale and capital and ability to enhance value, I'm going to talk about these together. So where we really focus on, we want to avoid value traps, and there are enough of them out there, companies that look too cheap to be true, but the same thing might be happening year in, year out to keep them cheap. We look to how we can really help make a difference in our investing companies, or see that a real difference is being made. So to reiterate what I've said before, we're not just shuffling shareholder paper, we own real chunks of real businesses. And in the sub $300 million market cap space, and particularly that $50 to $100 million space that we specialize in, we get to know the board and management of our companies extremely well. And the litmus test for us is that we can have them on speed dial and feel that we can call them anytime and they'll be receptive to the conversation. We often find that a few small changes to an overlooked company that's down and out, no one wants to have anything to do with it from a share price perspective. And that could be something like insufficient scale or some governance issues. These small changes can make an immense difference and start really driving shareholder value when you have a good underlying business or asset. So that's what we love to be involved with. That's the opportunity. And we will join boards and really roll up our sleeves and be part of it where we see that's constructive. Now on this slide, I'm going to run through some examples of how we really envision our investments, and, practical strategy. So we always invest with a thesis once the occasional company gets through all of our screens and selection process. And following that, there's a period of incubation while the key elements of our thesis plays out, and it may require certain catalysts along the way. And this can take 6 months, but it can take six years and sometimes actually even longer. So we really do like to hold our companies for the long term while these series of scenarios play out. And at any point in time, our portfolio will be comprised of investments of companies with varying levels of maturity along what we see as our thesis. So we hold until those things play out. But of course, things can go wrong and we can go into negative return for a particular holding. But our focus, as I mentioned before, is to buy well enough that in a worst case scenario, the initial value that we invested can be recovered and more. And this is always possible because we do significant stress tests and we buy companies where there are real businesses or assets and limited to no debt. And the inherent value of these companies can always be realized through active involvement, which, as I mentioned, involves rolling up our sleeves, working with shareholders, directors, and joining the boards where necessary to help realize the inherent value. Now, I'll point out a few of these companies on the slide as examples. So PV, which is Pearl Valley Energy, is a company that the fund has actually held since near its inception in 2014, near the fund's inception, that is. In 2007, I should say. And we really, so it's almost 15, 16 years, and we really doubled down in 2016 after we'd gone and made a bit of a loss there. But this is a company that owns Italian natural gas assets, and there was a long-term belief that those are strategically important assets. They're worth something, and sometimes the market just couldn't care less about them. So we stuck with it, helped recapitalize the business in 2016, and then I joined the board of that just over a year ago to really help progress the company, help realize shareholder value, help with some governance, and that's really been part of this whole journey. Is helped that share price go up by 2.5 to 3 times over the last year and a half, and again, it's taken that more than 14 or 15 years for it to come to fruition, but the IRR is still very, very attractive and in line with our expectations, and we've been patient. A sort of almost opposite example of that is PTG, which you can see on the top right there. And unlike PVE, which we still hold, PTG has been realized. We invested in that about in June, July last year, and this was part of these technology companies that had been sold off so dramatically by the stock market. And it's a company that does real estate software. And we thought it's got a massive part of the share of the market, but had been priced to almost as if going out of business because people just didn't want to have anything to do with that sector. So we invested into that, and the thesis was that over the long term, value would come back as people realized that they have a near monopoly in the space. And lo and behold, 6 months later, they got a very solid takeover bid at a more than 100% premium by a US equity fund. So we were able to achieve a fantastic IRR. And again, that happened very quickly, but it's not always forced away. Another company I might just touch on in a bit more detail is CAF, which you can see in the middle, that's Centrepoint Alliance. And that's a company that we've held since around October 2019. And it's a nice example because this shows some overlap with the broader Hancock & Gore group, where our chairman, Sandy Beard, is the director of CAF, coincidentally, but we've worked together and had similar investment approach to buying a company where this group has financial advisors that it provides services for. It had been priced to extinction in 2019 because of all the uncertainty amongst in the financial advice industry, but it still had a fantastic core underlying business and very highly rated advisors. So we bought into that. It had enough cash on its balance sheet to find its way through without having to raise any money and still be able to return cash to shareholders. So it's been a very good value play for us, and we've had a decent IRR, but we still believe there's more there. So we haven't decided to realize it. It's currently in a very solid position as the largest of these kind of $40 to $60 million market cap financial advice businesses, of which there are about 5 listed on the ASX, where consolidation really should happen, and we believe will happen over the next 1 to 2 years. And so there's more to play out. And again, we engage very closely with the board of management towards strategic realization of inherent value. The other two briefly mentioned, Kill, Kyland. It's been a very long-term holding of the fund, again, 15 years or more, owns a lot of land on Kangaroo Island. And CNW is Cirrus Networks, and that's a more recent investment for the fund. And again, those are earlier stages of what we see as the life cycle of the investment. So the team is, as always, probably the most important thing. And I'm extremely lucky in that point. We as a team are very lucky to have, as I say out there, a lifetime of experience. So the chairman of HCF is David Groves, who's been on numerous public company boards and has fantastic experience dealing with real businesses and driving shareholder returns. Nick Atkinson, who's an executive director of HCF, was the head of institutional equities at Morgan Stockbroking. So he just knows the whole industry inside out and knows really everyone. And it's invaluable to have someone of his caliber to be able to work with. And then I mentioned Sandy Beard, who's the chair of Hancock & Gore. And again, has been on numerous public company boards and has just a wealth of knowledge of all the participants in the industry, and again, how to roll up one's sleeves and realize value. Arthur works with me on a day-to-day basis on HCF, and he's always the smartest guy in the room, and he's an excellent analyst. And we're very lucky to have someone with such fantastic attention to detail when it comes to analyzing companies. And then finally, Phil Christopher, who's an investment director of H&G and has experience at Goldman Sachs and Alcyon, working in the private equity space and doing deals and knowing how real M&A activity goes on a day-to-day basis. And here I'm going to touch on what we came out to say when we did the IPO back in October and how we fared since then. And I think it's always important to hold ourselves to what we say we're going to do. So the first thing we said is that we're going to take advantage of this so-called tech wreck that occurred towards middle and end of last year. And we were very excited to be able to invest $1 million into PropTech, which, as I mentioned earlier, attracted a takeover bid and produced a 230% realized return for us. That's on an annualized basis. The second one is investing in 2 new target companies. One of them I mentioned, we've invested $1 million into Cirrus Networks, and that's so far unrealized produced an annualized return of 25%. And we're currently accumulating another target that we mentioned at that time on market. Sometimes in the microcap space, it takes a lot of time to actually acquire stock, and we prefer not to mention the names of the stocks as we're still in the market. We also mentioned we were out looking for new recapitalizations and opportunities after the sell-off, and we've opened 4 new positions in companies and met with more than 50 companies and so many potential recapitalizations. And we've turned obviously many more down than we've taken, but there have been some really interesting opportunities and more to come. We've invested $0.8 million into what were the top 5 holdings at the beginning of this financial year, and that was as the market sold them off, and we believe they were of significant value. We said we'd raise $10 to $20 million and list on the ASX. It was a very challenging market in October last year, so we raised $5 million, and we've since deployed $2.2 million of that. We also said we want to pay dividends to shareholders, and we just declared our first dividend. It was an interim dividend of 2 cents per share, at this stage unfranked because we haven't paid any tax yet. And finally, we said we'll really focus on transparency and engagement with investors in the wider investment community, because for an LIC, that's crucial importance to keep getting buyers in and keep interest. So that's something that we're laser focused on. So really, in closing, why buy shares in HCF? Well, as I mentioned at the beginning, we believe that we're the experts and the place to go in the public market for this microcap specialization. And that's an area that we believe can provide outperformance over the long term, because we're looking at these companies that are just not on the radars of most institutions. We intend to continue paying dividends, and once we get our franking credit balance up from paying tax, once we get to June, we intend them to be fully franked. And we really believe this is a fascinating and great time to be investing. Illiquid microcaps, you may or may not know, have not been favorites for many investors, especially institutions, and they've been sold off quite dramatically. And so we're seeing a plethora of opportunities, and we're very excited about that right now. And that extends to not just buying on market, but also recapitalization opportunities as companies' debt suddenly comes up for renegotiation and it's too expensive, and they want to put in equity. So I think I'll leave it at that. And I really appreciate your time and would love any questions. And my contact details are up there. And I would love any time you want to chat markets or ask any questions about our individual stocks, strategy, or the economy at large, please feel free to call or email them.
Excellent. Thanks very much, Joseph, and congratulations on the performance today since the IPO and before that. So just as a reminder to all attendees, we'd love to hear your questions. Rather than raising your hand to speak on the line, please put your questions in text format in the into the Q&A panel, and we can address them that way. The first question that's come through, Joseph, has asked about the dividend. So the question is, why raise money and also pay a dividend, in short?
Yeah, thanks for the question. So we see them as two separate things. We've been in business, as I say, since 2007, and over that period have had a track record of returning the realized profits and the dividends that we receive from our underlying holdings to our investors. And that's something that we committed to doing from the beginning when we moved into this LIC structure, and it's what we told the market as well. And we believe that is the right thing to do to our shareholders, is return those crystallized profits. So as they're apparent, and we, as I said, we sold and realized our holding in PropTech, we felt that's what we'll do for our shareholders. And raising money was obviously something separate about going out and investing that into fantastic opportunities. And we think in the LIC world, it's an attractive thing to have access to fully franked dividends.
Yeah, thanks, Joseph. And on a related topic, another question is asked, have you thought about offering a discounted dividend reinvestment plan?
Yeah, that's something we have considered, because it's pretty early days since we established the LIC. We haven't done that for this dividend, and that's something that we will consider for future dividends.
Yep, thanks, Joseph. Another investor has asked, can you talk to the sort of approach that you take to manage risk in such a concentrated portfolio?
Yeah, thank you. That's something that always thinking about, and it's the most important thing. So first thing is we always looking at companies where we believe there's a strong margin of safety. When I say that, I mean we're buying at a low enough price that if something goes wrong, there's safety and the company is worth at least the same or more than what we bought in at. And that's maybe because of its assets or because of its running business. So that is the key. That's really, from my perspective, the key way. And these are almost always debt-free businesses or highly net cash position, or if they do have debt, it's backed by a lot of assets. So that really lowers the risk. And yes, you might have some share price risk in the short to medium term, but if things are not going well, that's when we roll up our sleeves and join the board and get involved. And we don't just let the companies keep falling down. So that's really how we look to mitigate risk. We're high conviction, but it often takes time to build really strong conviction. So it's unlikely we're going to invest 10% of the portfolio on day one. But over time, we get to know better. The more we get to know management, the more we feel like we have some sort of involvement with what's going on, or management's receptive to it. So if we get in to begin with, and then we decide that something is not quite right or the thesis is wrong, we will then have a small enough amount that we can then sell those shares, if that's the case.
Yeah, well, that's it's quite closely related to a question which another investor has asked, just pointing out that some of the investments are quite illiquid. The question is what the strategy is to exit a position if a company that you have a decent investment in may have negative updates. But I think you've sort of answered to some extent there in pointing out that you don't sort of you don't put all the chips in immediately. You sort of maybe you can talk to it, Joseph.
Yeah, as I say, we would let things run. We are unlikely to invest too much of our portfolio into one company, but we will let them run so they can become bigger parts of our portfolio as the share price goes up. But in terms of the capital that we're risking, we are very focused on that, and we ensure that when we're buying in, there is that margin of safety. So yeah, things can go wrong, business environments can go wrong, but there's from what we bought in at, we assume a lot that goes wrong, and we still get our money back. But that doesn't often involve rolling up our sleeves, getting involved with the company. So it might not be an immediate uplift, and there may be periods of volatility in our performance. But that's really the key way. And we often find as companies perform and do what they say they're going to do, and the catalyst and our thesis plays out, the catalysts become apparent, we do find that liquidity always comes. And a good example is something like a Po Valley Energy that I mentioned that at some point traded every few days, and that's really when we started to get involved, and now the volume has picked up quite dramatically. So they all make a big difference. Yeah,
good example. When you're assessing companies as potential investments, what sort of things do you mean by due diligence on companies that you're looking at?
So we want to get to the position where we feel like we are the experts in that company, and at least from the investment community. Otherwise, it's hard to feel like we have an edge. And sometimes we would like to feel like we even know more about certain elements of the company than even the management does. And it's less likely to be the industry, but more the history and some of the other dynamics. So what that means is we will speak to competitors, we'll speak to suppliers, we'll speak to customers. It's a lot of phone calls, it's a lot of time trawling LinkedIn and really working out what are the real underlying dynamics. We often speak to ex-employees of these businesses. We're obviously traveling a lot to visit companies, meet with management. So those are some examples of that. And of course, goes without saying, you have to have read every single company announcement of that ASX company announcement of this particular stock. We really just do the most thorough research we can, that we feel like we know more than most.
Sounds good. Thanks, Joseph. Just coming to our last couple of questions for the moment. So certainly encourage attendees to pop your questions in if you do have them. Turning to the portfolio, the question is asked if you can talk to your view on FOSS Capital. The point's made that there's good revenue growth there, but yet to see the impact on profit growth.
Yeah, so we like FOSS Capital. We participated recently in placement for that, and we've held shares for some time. Yeah, positive on the outlook, and think that this kind of business requires scale. And I think we back management that they are the right people to go out and acquire some new businesses and build a meaningful lighting business in Australia. And very positive to see that organic growth and revenue coming in. And then they've really got the fixed costs in place now to go out and pretty much add incremental earnings through the business. So that's really there. We feel like they're at a strong inflection point, and we'd expect to see those profits coming in over the years to come. And we're there for the long time.
Cool, sounds good. Just coming to the final question for the time being, an investor has asked if you're able to explain the fee structure again.
Yeah, certainly. So we have a fee of a 1% management fee, and that's 1% of the portfolio value. And then we have a performance fee, which is 20% of the excess return that the portfolio generates above a 5% flat benchmark. So that means that's per annum. If we go under, we have to recoup losses before we start making a performance fee again. And we obviously don't make a return if we have a negative performance. We have to be above that 5%. And I'd encourage you, if you want any further detail, to look through worked examples. Our prospectus, which is lodged and it's on the ASX, goes into even more detail on that.
Yeah, great. Just another question from an investor is made the point that they find that their ETFs and listed investment trusts are forced into selling smaller liquid stocks during runs on redemptions. And the question's asked if your company does or would suffer from the same issue.
Yeah, I really like that question, because that's a big reason we actually became a listed investment company. So it's permanent capital. We don't suffer at all from redemptions. No one. So that it means that when we invest in something, we have that certainty that we can stick through the cycles. And yeah, it is a really important difference. Whereas ETFs and funds in general can often have the kind of dual issue that when markets are going up, more flows come in and they have to buy more, and they're buying a lot at the top of the market. And when the market goes down, they're getting redemptions and they're selling, and they're often selling at the bottom of the market. Whereas, we're in a fantastic position. It's permanent capital. We can afford to buy more as the market goes down and sell as the market goes up, if that's what we want to do.
Excellent. Thanks, Joseph. That concludes the Q&A component for the time being. So thanks to all attendees for your questions. And on behalf of the company, I'd really like to thank everyone for tuning in. Actually, but before we sort of draw a line through things, I do note that we do have one more question, which is asked if there are any initiatives that you can do to increase the liquidity in the traded stock, Joseph.
Yeah, that's something we're mindful of, and we are always thinking about that. So this is part of these initiatives, webinars. We intend to go and do some investor briefings in the next few weeks, going to it. And I should say this, if you are in Brisbane or Melbourne, please get in touch, and we'd love to have a personal meeting with you. But so we're going to speak to financial advisors and other brokers and high net worths and other funds who had invested in the first place into our company and the broader market. So that's really part of our strategy. Get the word out as much as possible. It's early days. Once we get an established dividend and hopefully yield and more following, we expect natural liquidity to follow. Yep,
wearing out the shoe leather is the key, I think. So yeah, that's good.
So.
So with that, as I said, we really appreciate everyone joining us today and for your continued interest in Hancock & Gore High Conviction. If you do have a question that we didn't answer today, please reach out, and Joseph and his management team will be happy to discuss further offline. We will also look to make the video recording of this session available online. Really looking forward to the opportunity to talk to everybody again. And Joseph, I might pass back to you now for any closing comments.
Thanks, Tim. Yeah, and finally, very much appreciate all your time for watching this, and all our investors for your support. And as I say, please, my contact details are there. Feel free to get in touch anytime, and I would love to chat.
Excellent. Thanks, Joseph, and thanks, everyone. We'll chat to you again soon.